Hello and welcome back. This is Roger Royce. I'm a corporate partner with Haynes Boone in Palo Alto doing emerging growth and venture capital. I'm also the host of the 10,000 Startups podcast. And today our guest is Bob Dunn. He's the managing director of GF Data, where he leads all aspects of the business for its new owner, the Association for Corporate Growth. Congratulations on that. Today,
Thanks,
we're going to
Roger.
today we're going to be a little more focused on private equity, and it's all about data. And Bob is going to give us a summary of what the data look like in private equity deals for the last year and maybe a little beyond, and can maybe give us some clues to what we can expect going forward. And even though that's not venture capital, these days the private equity markets and the venture capital markets seem to be more and more closely related. I am seeing so
Yeah.
much more private equity in the startup space now. It's really kind of running together. Before joining GF Data, Bob was the Chief Development Officer and General Manager of Portfolio Management Research for With Intelligence. And prior to that, he ran hedge fund intelligence and institutional investor intelligence for a Euromoney Institutional Investor. And before that, he ran Dow Jones Private Markets for Dow Jones and Company. He's got experience in both the corporate and startup environments and a deep knowledge of public and private markets across all financial industries. Well, with that, Bob, I think I'm going to let you take it away.
Excellent. Thanks, Roger. Thanks very much, and appreciate you having me on. Before we actually get into the numbers, and again, where I think your audience is a little more attuned to the venture landscape, I just want to give some quick background on how GF Data tracks and gets its information. The company was established in 2006. We have data going back to 2003. All of our data comes directly from a network of private equity groups that submit their transactions to us on a quarterly basis. That's completed transactions. And we take that information, quality assure it, anonymize it, and then put it together in a series of reports in an online web tool that allows our users to drill down into the data by broad industry category as well as by NICS code. The data that comes in here, we do have some restrictions on it. We just track deals between 10 million and 500 million in total enterprise value. And then in terms of purchase price multiple, we have governors on it. We only look at deals between 3 times trailing 12-month EBITDA and 18 times trailing 12-month EBITDA. And the rationale for that is very much what you're just alluding to, Roger. We want to make sure that we're focusing on the control-oriented mid-market buyouts predominantly. Nothing against more venture capital type deals, nor distressed situations, but just to keep like for like, we like to have some parameters on it. So let's jump into it. We've put out our 2023 full year report, and this first slide that you're seeing here is representing that data. You see we have just over 5,000 deals total in the database. And for 2023, you're seeing some interesting factors going on. The first thing I'd call your attention to is the N line down here. That represents the total number of transactions that we recorded in the last year. So for 2023, GF Data recorded 269 reported transactions, and that's what last year's data is based upon. When you look at the totals for 2022 and 2023, you see that we're well off last year where we were for both 2022 and 2023, about 17% off the total for 2022, and then about 47% off the total for 2021. Now, what's that telling us? It's telling us that deal flow is obviously way down from where we've been in 2021 and also from the prior year. But I think it's also telling us that there's been a fundamental disconnect between buyers and sellers on pricing, and that factored in with the challenges in the debt markets that we've seen in terms of rising interest rates have created a dynamic where buyers and sellers aren't seeing eye to eye on the value of their companies, and they're basically trying to look. Buyers are looking to pay a little bit less. They're concerned about earnings coming out of COVID, and we'll talk a little bit more about that later. They're also getting pressure from their banks and maybe not being able to extend quite as much leverage onto the transaction to carry it forward. So that means that buyers are looking to pay less. They're always looking to pay less, but it's particularly acute at this time. And sellers are always looking for that little bit more and looking more for a market that looked like 2021. The other thing that I would note on this, and again, we provide our data based upon deal size tranches. You see that in the TV column on the left-hand side here. The smaller end of the middle market, so deals value between 10 million and 25 million, has really suffered the brunt of the debt markets and the disconnect between seller and buyer on it. So you see between 2022 and 2023, about a half a point turn difference in the average valuations for companies valued between 10 million and 25 million. And then in the total line here, we show you the historical average. So you see currently this cohort 10 to 25 million is just a tenth of a percentage point above the historical average. That's definitely unusual, and you don't generally see that. You haven't seen it the last couple of years here because the average is taking into account deals from as much as 20 years ago. But it definitely points to a market that's down for the smallest transactions, and then sort of a mixed bag when you get above it. In the groups below 100 million, you see some improvement in 25 to 50 million. And then a little bit of decline in the 50 to 100 million. Noting at the larger size transactions, 100 to 500 million, you actually see pretty significant increases here. We believe that's part of a flight to quality, that bigger is better in the minds of lenders right now, and that those properties weren't as affected by the debt markets. We go into the next slide on it. We can take a look at the quarterly splits out here. So this gives you an idea of sort of that inflated deal total that was happening in 2021 and 2022. You go back to the first quarter of 2022, you see 100 transactions tracked by GF Data. And then that number in the second quarter of 22 starts to drop down, averaging between 75 and 80 deals up through the first quarter of 2023, and then down into the 60s. And in the case of the fourth quarter, just 57 transactions total that we tracked. The interesting one to me was first quarter 2023, where you said a notable uptick in total number of deals completed. Our belief is that is a lot of deals that made it through, didn't complete in the fourth quarter, and were left to be done in the first quarter. But what you had, there was sort of an artificial uptick on it for the first quarter of 2023, which really wasn't sustainable on it, particularly after the Silicon Valley Bank going into insolvency, which I think we do need to remind people out there, this is the second largest banking failure in US history. I think in that context, the markets are actually doing very well compared to where we were a couple of years ago. Looking at the other interesting bits in the quarter, so I'd said smaller deals valued between 10 million and 25 million were under pressure. You're actually seeing some improvement on that, really in the sub 50 million market, with more than half almost a 0.7 of a turn of EBITDA difference between fourth quarter 2023 averages on the 10 to 25 million segment versus 5.9 in the third quarter and 5.2 in the second quarter. And again, I'm sort of discounting that first quarter 2023 because it was a mixed bag of things that came over past the end of the year. And I think a lot of deals that have been under letter of intent for a significant amount of time, but finally ended up closing then. But you see a steady march upward in terms of valuations on smaller transactions. I think that's a really positive sign for the marketplace. It shows that deals are getting done here, and that the buyers and sellers are actually coming together, and that buyers are actually able to put a little more money into those transactions to get the higher valuation on it. We'll talk a little bit about the mechanisms for that in a moment. Conversely, on the other side, you start to see a reverse a little bit of the bigger is better side, a drop in the $100 million to $250 million deals. That's a cohort that's less well represented than the small deals within our database. But I do think some of that confidence in bigger is better and those companies is now starting to erode away a bit, and that the pressures that were on sellers for smaller transactions are actually starting to migrate up market. So this is an interesting slide. And again, I think this comes into my perspective that we're in an improving market right now. The quality premium, we take companies with greater than 10% trailing 12-month EBITDA margin and greater than 10% trailing 12-month revenue growth. And it needs to be both of those factors, not one or the other, and put them in a bucket that we call above average financials. You can quibble with the levels that we set there, but the point is we're splitting up the market between those A properties out there, which generally always do well, versus the B properties that are a little more questionable in terms of will to be for valuation. What I thought was interesting on this is in the end of third quarter 2022, we got to the smallest premium on above average companies. You see that here representing the 22% uplift on it. That actually dropped down to just 8% for the first 3 quarters of 2022. And the incidence of the above average deals, so what percentage of those deals in the marketplace were above average, had above average financials, made it to 71%. Now, in looking at that, that tells me that third quarter 2022 very few companies that did not have exceptional fundamentals actually completed deals at that time, and the market was dominated by those businesses. This tells you that lesser companies or companies of B tier really weren't even choosing to transact, and we're staying on the sidelines on it, which I think is indicative of a very challenged market. It's the only ones who are willing to go into the pool are the best swimmers. What you see now at the end of 2023 has sort of reversed that situation. So now you see a 28% premium, which I believe is the highest premium we've seen in the last 4 years, and incidence of these deals of just 48%. So we're seeing fewer above average proportionally going into the marketplace, more normal companies, less exceptional companies choosing to transact, getting out there. The 48% is below the historical norm here of 57%. So more than half the companies out there were not above average by our standards, but they still get deals done. And then the difference in the market, that 28% premium, trailing 12-month EBITDA multiple of 8.2 times versus 6.5 times for the more average companies. That's a high difference in terms of pricing. What that tells me is that not only are companies that are possibly blemished or not A properties are going out, are transacting, and the pricing is being built into it. So I think, again, when you talk about a market where there's a disconnect between buyers and sellers, that's an important factor, that these companies are coming in there. Maybe they're getting less money, but the sellers are actually going through with the transaction, and they are looking to trade. So this is another factor that we've seen in the current market, and I think one that will persist or maybe start to slow down a little bit. And that's in the contribution of rollover equity by the seller. So you see here, compared to 2022, we're up more than about 1.5 points in terms of contribution of rollover equity. This is, to my mind, a real opportunity for sellers out there right now because of the debt markets. Sponsors are having to put more equity into transactions, and they're actually letting some of that equity get into the hands of the sellers on it. They're staying with the business. This potentially sets up a situation where a seller, if they're going to stay with the company for a bit, could do as well, if not better, on a subsequent transaction with that rollover equity than they did in the actual sale of the business to begin with. Now, what's driving this is really what you see on the top here, about a 3 percentage point discount in the percentage of senior debt composition of transactions between 2022 and 2023. And not much movement on the subordinated debt side on average. I was expecting more there, but it seems like the seller rollover equity is really coming in, and that's sort of plugging that gap that you normally see for subordinated debt. I will say anecdotally, we do have a lot more participation by non-bank lenders right now. That kind of makes sense in the marketplace. For much of last year, we saw little to no activity among banks supporting private equity transactions. They're starting to come back in the market right now, but that senior layer was definitely stressed in terms of coverage. And the sub-debt funds came in and were particularly strong at the second half of the year. They're charging more, obviously, but we have seen an uptick in non-bank lenders, as well as unitranche financing among the deals reported with us. Next slide looks at just kind of the market overall based upon deal size. You see 10 to 25 million on the left, 25 to 50, all the way up to 250 to 500. The two big takeaways I see on this slide is that subordinated debt has gotten much, much more active in the 10 to 25 million range. From talking to our contributors in the mezzanine space, they're saying they're seeing better companies they've seen in the last 20 years. And it's kind of they've kind of forced to be taking it to the subordinated debt side because senior lenders aren't covering that difference in price on it. But as you move up deal size, as you would expect, the subordinated debt portion goes down. But I think looking particularly at 50, 100 million, and then also at 250 to 500 million, these are both extremely large amounts of rollover equity that's going into deals. And that's not something that a sponsor is generally going to allow to happen unless they really believe in the transaction and really wasn't able to get the financing on it. The additional equity you see going in, represented by the gray layer there, that's obviously all coming from the sponsor itself. They've upped that a bit. It's not shown in this slide, but really the delta on it is the seller rollover equity that's coming in to cover the pullback on the senior debt side. I will say there was always some component, as you know, of rollover equity in a transaction, but I think that generally historically has run more to the 8 to 12% on it. And what you're seeing here is about 5 percentage points or more uptick from there. And we're just rolling through now. Got a couple more slides, or actually last slide here. So I think this is the other big part of the story on it. This is debt pricing with the bottom line graph showing senior debt coupon over on a quarterly basis. And then the top is the sub debt coupon. So the sub debt line, just to reinforce, does not include fees and other charges on it or PIK notes. That pushes it up a bit to about 14.5%. But when you look just at coupon, what you're seeing is a convergence between senior lending rates and subordinated rates, really starting right about the fourth quarter of 2021 and the second quarter of 2022, and moving up very, very substantially over subsequent quarters. It's been between a percentage point and a percentage point and a half increase to senior debt rates on a quarterly basis throughout last year. The good news on it is, I think, as we're all aware, Fed signaled they'll be stabilizing rates and potentially decreasing them. I think that should greatly help the marketplace. There's a bit of a mentality of, not wanting to catch the falling knife when rates are going up. I think we can definitely do deals and have transactions completed in a robust manner in a market with high debt rates proportional where we've been the last 20 years. But the rising rate side, I think, spooks everyone a bit, makes lenders a lot more cautious. The other thing is we've been in a high interest rate environment for several quarters now, or higher, if you will. And I think banks have managed to adjust their balance sheets, take the actions they need to do to make sure they have the capital cushion available. And I feel like they're coming back into the market as well. The big thing to me, that's not represented in the slides here, but I think will really unlock the dam is the private equity groups themselves and them looking to exit their existing portfolio companies. The pressure is definitely being felt by sponsors from their limited partners. They have not seen a lot of returns in the last year, and I think that's something that is similar to many of the folks on the venture side that you talked to, Roger. But that pressure has gotten to an acute point on it, and I feel like particularly for firms that are planning to go out and raise a fund in the next couple of years, but really any firm that has institutional limited partners, they're under pressure to return money. And that's going to mean that some of those companies that are holding on for better financial markets to sell will actually be coming to market probably earlier than they had hoped, just to get some returns back to the LPs. When you have that sort of a wave come through, and I do think it'll be a bit of a wave, I don't know exactly when it will happen, I think that's going to flush out a lot more family-owned and individually owned businesses, because the pool looks more inviting when there's more transactions going on. You talk to your banker, banker's busy, banker's doing a lot. That creates a sense of urgency for sellers, and I think will increase the total number of companies coming to market. So I think private equity exiting portfolio companies, stabilization in the debt markets, and what we've already seen in 2023, some coming together in the views of buyer and seller on actual valuation, and also some mechanisms that can be used to help that. We recorded for last year, nearly 48% of deals included rollover equity or seller financing. So that's coming into, rollover equity or earnout on it. That is, those are both mechanisms to kind of sweeten the pot for sellers and to bridge what might be a valuation difference on it, that they could get it on a earnout subsequently, or through the rollover equity again when the debt markets get a little bit better. So yeah, the creativity I think in the market is pretty impressive right now. It shows that there is a desire to get deals done. We're seeing more equity, both seller rollover as well as sponsor equity, go up in deals. That definitely changes the return profile for transactions. But I think there's a belief that we can get through this. We'll do a little more equity on deals, and wait for interest rates to actually start coming down to get a bit more active.
Okay, thanks very much, Bob. A couple of thoughts as I look through this. It's given the cost, looking at your current slide of what senior debt has gone up, it's kind of surprising we've had as much activity as we have, to me.
I agree completely. Yeah, it's I think we really need to take into account how different the market is than it was 24 months ago on it, right? And I say it regularly, but you've had folks who've done their entire career in a low interest rate environment, and this sort of sprang up relatively quickly in conjunction with the other shock of COVID and quarantine. I think that's something that you're also seeing have an impact right now. I talked to GPs, and they're having a lot of time figuring out what the glide path is for companies they're looking at, because 2021 definitely, and to a degree 2022, were very different sorts of markets, very different There's a lot of consumer spending out there. There was limited places to spend that money because no one was going anywhere. So I think you saw increases in earnings for a lot of those companies. That the question now is, are those sustainable, and will it actually just be a blip from that period of time? So I think that's another challenge on it. But yeah, given these factors, I'm actually pretty impressed that we have seen the activity that we have in 2023.
Yeah, and I find it interesting, a comment about the pressure to exit. I mean, I just anecdotally, I'm seeing an uptick in deals, and maybe that's why. But we'll see. We hear that every year, and you just never know. But
Yeah,
dam's gonna break one of these days, right?
Yeah. And there's certain, I mean, obviously in this market, it can feel like whistling past the graveyard, but I do think the signs are there. And I do think, as you mentioned, anecdotally, at least over the last few weeks, we've heard from people that they're as busy prepping companies as they were in early 2020 or late 2020, early 21. It's just a matter of when they actually get to market on it.
Yeah.
But I have heard from one institutional GP had mentioned that, hey, we're not equipped to manage this many portcos with where we are right now. We need to make some exits. They've still been buying, but they haven't been exiting. So I do think there's a pressure point that it's getting more acute by the day that will have an impact this year on deals.
Yeah, and I guess the last comment I'd make is I find it interesting that the rollover amounts are increasing, and I've seen that as well. And that's a little bit of a mixed bag because you're now you're a minority interest holder going forward in something. But on the other hand, like you said, you got that opportunity to have a second bite at the apple and get a second return on a second exit.
Yes, I think that's right on it. And it is, I think it can be challenging, particularly for a family or individual selling on it, because as you said, they're going to be pushed into the place of minority shareholder, which I think there's concerns about. On the flip side, though, presumably in all the diligence you've done, you've gotten comfortable with the sponsor, you believe in their plan, you believe in what they could do for the company, and you know that you're going to be looking at a liquidity event in 3 to 5 years if everything goes according to plan. Now, everything won't go according to plan, but that company will get sold again. And the other one on it too, I think, is alignment of interest, right? And you see that the same with, earnouts as well as rollover equity. Seller asserts that the company is going to continue on the upward trajectory that they were at. Well, okay, put your money where you believe that is on it. And I think this is an opportunity to do that. Doesn't work in every situation. I think particularly for folks who are selling and are on the older side, they may not want to remain involved in the company. But again, if you are looking for continued stake or continued involvement, there's no better time in the market than right now to get a deal done.
Gotcha. Okay, well, I want to thank you, Bob, for being here today. We've been talking with Bob Dunn, who is with GF Data, a division now, I guess, of ACG, talking about some of the data around private equity deals, which kind of drifts into my space as well. This is Roger Royce, the 10,000 Startups podcast, and we will see you next time.